All right, so in this video, I'm going to talk about diversification and how that relates to risk. So in prior videos, I've talked about unsystematic risk and systematic risk. Systematic risk is basically that market risk, or it's kind of inherent in the system, is linked to big economic shifts, things like that. Unsystematic risk is more company specific, unique to a particular situation or company, their product lines, perhaps, things like that. Now, what's important to note is what happens with diversification. So when you diversify, basically what happens is the diversifiable risk or the unsystematic risk basically declines. So what I have on this graph is I've plotted risk on the y-axis and then sort of the number of stocks in the portfolio on the x-axis. Now, I'm using stocks as sort of an example of this concept. You don't have to necessarily use stocks. The general concept generalizes more broadly than just looking at stock investments. But the basic idea here is that when I have just a couple stocks, I have a lot of exposure to factors that are unique to those companies. So if I just invested in, say, 5 stocks, if there's some kind of a big problem with one of those companies' products or a big lawsuit, or they get they run afoul of SEC regulations, or who knows, whatever, something like that. Well, if I only have 5 stocks, if I evenly split my money across those 5 stocks, one stock would be 20% of my investment. And so if anything happens to that company, that's a big deal. That could really affect my portfolio. And so basically what that would mean is my risk is actually kind of high because I've got a lot of exposure to those unique factors that are company specific. Now, as I invest in, say, 10 stocks, I would actually decrease the amount because now I only have 10% of my money invested in any particular investment. So yes, it's still going to affect me if something happens to one of those companies, but I've shrunk the amount of exposure I have to any one company quite a bit. So my diversifiable risk has gone down. And then if I go all the way up to, say, 30 stocks or maybe 50 stocks or 100 stocks, basically as I start increasing the size of my portfolio, basically what happens is I start caring less and less and less about any specific, company particular issue. So if I have 1,000 companies in my investment portfolio, I don't really care about what happens to an individual company as it relates to, some kind of a product problem they have, a strike, or a disruption in their supply chain, or a regulatory issue, or what have you. It doesn't really affect me that much. If I evenly split my money across those investments, that would be 1/1000th of my money. It's just not going to keep me up at night. So from that standpoint, basically, I eliminate the diversifiable risk. In other words, I don't really have to care about the company specific issues anymore. I will still have at that point the market risk. So the exposure to the market risk. In other words, I still have systematic risk. Now, what kind of portfolio of 1,000 companies may affect even what level of market risk I have. So if you go back to the video I had about systematic risk, I did note that you can decide sort of how much exposure to systematic risk you have. And so depending upon what kind of portfolio I construct, I could diversify really broadly, so I don't have to worry about the unsystematic or diversifiable risk anymore. But depending on the portfolio I've constructed, I can adjust kind of my exposure to the systematic risk, perhaps. So some of those very diversified portfolios would have much more exposure to a systematic risk. Others would have much less. So it might depend on what kind of portfolio I created there. Particularly if I started including assets that are not just stocks. I started including real estate investments and bonds and stocks and foreign equity investments and international bonds. And so I start incorporating multiple different asset classes. I can have a very diversified portfolio. I don't really have to worry about the diversifiable risk anymore. And now I sort of just kind of can fine tune my exposure to the systematic risk depending on what kind of portfolio I've created there. Now, I do have a little note on this graph that's worth noting, and that is this plot is showing you as the number of stocks in the portfolio increases, the diversifiable risk decreases. But this is sort of on average what you would have for portfolios with these different levels of stocks. And that's kind of assuming, therefore, that I'm doing sort of a random selection. So in other words, if I'm dealing with like a 5-stock portfolio, if I just pick 5 stocks at complete random out of several thousand, then this plot is giving you sort of an idea of the fact of what kind of level of diversifiable risk I would have compared to if I just had like one stock picked at random. But if I had 5 stocks that I didn't pick at random, and let's say it's all 5 stocks in, let's say, the auto industry or something, then this plot wouldn't necessarily correctly show the amount of diversifiable risk I would have here. Because basically, if I had 5 stocks all from the same industry, I'm actually not even getting much diversification benefit at all. And so this graph would actually tend to show that, hey, I got some diversification benefit with 5 stocks, but if they're actually 5 stocks all in the same industry, the reality is, actually, I'd probably still have a lot more risk. It might be way up here still because they're all in the same industry. So that's why I have this little note here that it's assumed to be random selections for these different portfolio sizes here. Now, by the time you start getting to, say, 300, 400, 500 stock portfolios, even if it's not random, you've got so many stocks in the portfolio, it starts getting almost difficult to create something that would have a huge amount of diversifiable risk with that many stocks. So it still would start to kind of approximate that. So generally, the way you can think about it is this is sort of on average the amount of diversifiable risk you would have. But really, there's sort of a range around this depending on what kind of portfolio you constructed, which group of stocks. And as you get further along with having more and more stocks, the range gets closer and closer and closer to kind of this average. And as you get more and more and more stocks, basically that diversifiable risk just shrinks till eventually, after a certain point, realistically speaking, pretty much all you have is systematic risk at that point. So ultimately, the big takeaway from this is have a diversified portfolio, because if you have a diversified portfolio, you can just flat out get rid of the diversifiable risk. So generally speaking, it makes a lot of sense to have a well-diversified portfolio because you eliminate those company-specific factors. It gets pretty dangerous if you only have a couple stocks in a portfolio because you have a lot of company-specific risk factors there that are still going to affect your investment. And that should be something that would concern you. Hopefully this video has been helpful. Thank you so much for watching and have a great day.